You kind of alluded to a pattern, Arnold, of people buying the dips, and we've been trained for everyone who invests in the market has been trained for more than 20 years to buy the dips. If you bought the dip, even before that, maybe going back to 1987, if you bought the dip of 1987 or 1989 or 2001 to 3, or the more recent bear markets during the great financial crisis or in March of 2020, you wound up getting rewarded for buying those dips. So I think retail investors have been conditioned to do that. So it kind of makes sense that professional investors or institutional investors might be in a selling mode while retail investors are buying the dip. Does it have any importance? The short answer is no. I wouldn't say, because let's assume it's correct, because institutional investors are selling and retail investors are buying, therefore name your hypothesis. I wouldn't say there's much significance to the pattern other than that it's happening. I would say that institutional investors like myself probably are looking at some measure of fundamentals more than retail investors do. And so perhaps they're seeing something in the fundamentals, by which I mean the underlying, so to speak, true, with air quotes, true value of stocks that tells them perhaps prices are too high in some sense, and we can talk more about that later. So I'll leave my comments there.
Do you agree with that? That they're too high? Are you one of those professionals that thinks that valuations are too high?
I do actually, and I can delve into the details of why if folks are curious. But I don't think they're wildly too high. I think they're a little. I think they're too high, but within normal bounds. The one variable that concerns me the most is whether the Fed has to raise interest rates and whether the bond market in general has to raise interest rates more than they've already done. And I think the answer to that is yes. Interest rates are still too low, and I can qualify that statement. And if interest rates are still low and they have to go higher, that's a real headwind for the stock market. So under current conditions, the market is I would say a little bit too high. If interest rates suddenly went up another 100, 150, 200 basis points, or 1 to 2 percentage points, then the stock valuations would be even more difficult. So,
okay, let me bring Alan in, and with a kind of a different question. I guess I have two questions for you. First of all, there's this widespread view that stocks are less risky in the long run than in the short run. And I recall you gave me a pretty, simple theoretical argument against that one. You want to tell us why that mantra might not be true?
Sure. Well, first, let me just say that if stocks were truly less risky in the long run than the short run, then long-dated puts would cost less than short-dated puts, which is clearly not the case. But I think that, I think that
That may be enough of an answer, but go ahead.
yeah, but I think a more intuitive way to think about it would be to say, I think people confuse average rates of return with total rates of return. So, the analogy I like to use is that if you go to the roulette table and you play it 100 times rather than once, your your percentage winnings relative to what you lay out in total will get more and more predictable. That's the law of large numbers, the law of averages. That if you play the game repeatedly, your average return is going to sort of start closing in on the theoretical mean. But nobody thinks that playing a roulette wheel 1,000 times is less risky than playing the roulette wheel once. So the reason is because when you play it repeatedly, you're adding on more and more and more wagers. And clearly, if you wager 1,000 times, you're going to have much greater dispersion in your outcome than if you wager just once, even if your average winnings are closing in on the theoretical mean. So, so the analogy for the stock market is that if you invest for 1 month, you have some amount of risk. If you invest for 50 years, your average rate of return might close in on historical averages. That doesn't say that your portfolio has become less risky. Your average return might be getting more and more predictable, but your total return is, the risk of your total return is the deviation from the mean, in a sense, times the number of years or times the number of bets that you've laid down. So the dispersion of your final outcome gets wider and wider as you play the game more and more frequently. So this notion that you are becoming less risky in the long run is just a non sequitur. It's basically saying that because my average return is becoming more predictable, does that mean that my total return is becoming more predictable? And then the answer is clearly no.
Okay, let me ask you another one. One way to think about, just decomposing the value of a stock indexes is that you have the price times the price earnings ratio.
Right.
And, the earnings times the price earnings ratio. So I gather just from my casual reading of the literature that in recent decades, the PE ratio, the increases in the PE ratio account for as much or more of the gains in stock prices as increases in earnings. Is that fair, or is that? And if
I think if your horizon is sort of on the order of decades, then that's true. I think that if you start the clock the way you wanted to, if you start the clock at World War II or let's say 1950, I think a huge chunk of the advance in the S&P 500 has been a change in the valuation multiple rather than, earnings obviously have trended up as well, but
yeah.
But a large chunk of that has been a change in multiples.
So to me, that says that history doesn't necessarily predict the future, because it seems like valuations going up is one of those, something that can't go on forever stops. Is that a reasonable way to think about it?
Yeah, and there's this very influential paper by Fromm and French who who basically looked at sort of, they tried to back out what the surprises would have been in the PE multiple using alternative valuation models, the kinds that you would sort of teach in a very standard first semester MBA class, like, dividend discount model, something along those lines. And what they showed was that prior to 1950, the capital gains rate on the S&P, for example, over long periods of time very much mirrored the dividend growth rate, which is sort of the long run equilibrium prediction that you would get out of a standard model. And that starting in the 1950s, the capital gains rate really began to diverge from dividend growth rates. So their point was that people seem to be upvaluing the market more than any increase in the in sort of the sustainable or projected growth rate of dividends would warrant.
So, I've been active with my time machine a lot the last week or so. In part, I received an advanced copy of a book by Alan Blinder called A Monetary and Fiscal History of the United States, 1961 to present, or 2021 or whatever. And he spends a lot of time, as he should, talking about the 1970s. And what you notice there is just how high interest rates were even before the inflation really got going. And of course, they went to inconceivable levels beyond that. So clearly, one of the trends from 1950 to today has been a drop in interest rates, especially in inflation-adjusted interest rates. Alan, how does that fit in with these higher PE multiples? Is it another, what do we say about that?
Well, I think it fits in nicely. When I was listening to Matt and I was listening to your litany of all the past crises or past crashes, and I was thinking about that expression, unhappy families are all unhappy in their own way, that each of those crashes had its own idiosyncrasy. But on the other hand, there are some commonalities. I was thinking that the last few years reminded me a lot of the aftermath of the dot-com bust, where the Fed basically drove interest rates essentially down to zero, and then people began searching for yield by progressively moving into riskier and riskier asset classes, and you sort of had this big synchronized rise in all kinds of risky assets, and that worked great until it didn't. So I mean, to me, like this, this last, the post-COVID aggressive monetary policy and the post-dot-com aggressive monetary policy felt the same, with this sort of a decline in real interest rates, a sort of secular shift into riskier assets for people looking to make up that yield differential. And I'm never sure if this is a tautology or not, but if you kind of view that willingness to move into riskier and riskier assets as kind of a decrease in risk aversion, a lower discount rate, then that's a good reason why it pushes up multiples. And that's exactly what we saw leading up to 2006 and 7, and then leading up to 2022. And once that cycle is broken, it's an ugly fall from grace.
The another sort of time machine trigger for me was just, I think yesterday, the day before, seeing a interview between Nick Gillespie of Reason Magazine and this guy, Michael Saylor. Anybody raise their hand if you've heard of Michael Saylor? So seeing Michael Saylor sent me back to something that I compiled. The first blog I ever did about it started in very end of 1999 and went through a lot of 2000. It was called the Internet Bubble Monitor. And I was tracking different companies. Like every day I had a list of 5 companies that were valued at ridiculous rates. I mean, arithmetically, you could see that it was impossible for these companies ever to achieve their value. And one of them was a company called MicroStrategy that was headed by Michael Saylor. And that company was found to have misstated its earnings and had a big SEC enforcement procedure against it in March of 2000. And that really started to pop the internet bubble. So here he shows up 20 some odd years later And what's he famous for now? His MicroStrategy still exists. It is the largest current corporate holder of Bitcoin. And I feel like there's some kind of bad omen there. And speaking of the similarities to the .com situation, I wonder if if there's some potential for a sudden correction in that market. Anyway, Matt, do you have a view on this whole thing on interest rates and I think you mentioned a risk of them going up. The Fed is no longer our friend, right?
Right.
And if you've been, what do you just let me change the subject a little bit and just say, we also saw right before the little hiccup in this stable coin that made the news, that Fidelity was saying it wanted to create an ability for people to put into their retirement accounts Bitcoin. Maybe was that poorly timed? Do you think that's an asset class that people ought to be allocating a portion of their portfolio to?
I am a real skeptic about that. Nouriel Rabini's been writing a lot on that topic about how there's nothing there. I don't know if I would go quite that far, but I would say it's very difficult to value cryptocurrency. Now, that's not to say some people like Michael Saylor and others who are very well reputed investors haven't made a lot of money at it. I personally, I wish I had invested a little bit when I remember they first were trading, and you could have gotten a Bitcoin for about $1,000. And I thought to myself, what the heck is this thing? But the point is, there's no way, it doesn't have any fundamental value. And you could say that about dollar bills, which are according to one theoretical approach to money theory, dollar bills or any currency are the biggest Ponzi scheme ever. You could say that about gold, because there's nothing fundamental about gold that has value unless you count its utility value in jewelry or in some very limited industrial uses. But the difference with gold is gold has a multi-thousand-year history of the human race valuing it. So if nothing else, you have a long history of data on gold prices relative to the prices of other things. So that at least within the noise of statistics, whether gold is priced too high or too low relative to where it's always been. There's no history with cryptocurrency to speak of. I mean, maybe 10 to 12 years of history. So what? There's no fundamental way to value it. And what makes it more difficult is if you look at Bitcoin itself, and I suspect the same is true of the others, the volatility of Bitcoin is humongous. It's, to use the statistical phrase, the standard deviation of returns or prices on Bitcoin is 80% a year. That means it could go from 0 to 100 and back down to 0 again within the space of a year. And there's very little predictability about it. By contrast, look at stocks. The volatility of total stock returns, depending on the period you measure, is somewhere around 18 to 20% a year. So cryptocurrencies are 4 to 5 times more volatile than stocks. So how do you even know when to buy or when to sell? There's no fundamental value to tell you the price is too high or too low. And when you jump in, there's no telling where the price will go. And if you're lucky, like Michael Saylor supposedly has been for the last so many years, then you're able to liquidate at a profitable price. But
Well,
I think the reason Fidelity, to wrap up my remarks, the reason Fidelity has come out with this platform for trading Bitcoin in your IRA accounts is because they can. If people want to do it, doesn't mean it's necessarily the prudent thing for Fidelity to do so. I think they just feel like there's a market for it, so why not?
okay, so
If you like that smart money, dumb money dichotomy, Arnold, that you were talking about earlier, this has to be a great example of the dumb money getting into Bitcoin after the party is over. And if you think about what kind of assets should people be keeping in their 401k plans, this has to be one of the very last things that you think any prudent person would want to do.
but why would Fidelity want to be associated with dumb money? Or just they're so cynical that they think if there's
I,
demand, we'll meet it.
I think they're getting pressure from their customer base saying we want the ability to do Bitcoin, and they're basically caving in. And I mean, my personal opinion, it's financial malpractice, but I'm old, so maybe
Yeah,
I'm.
I know. I said at the outset that you guys are the same age as me and with some of the same background, and that's what you're getting here.
Yeah.
Um,
If I may, Arnold, to play the devil's advocate here, I could make a case for Bitcoin going. Now, it's not a forecast. I'm just playing devil's advocate. I could make a case for Bitcoin going up to something like $100,000 or $120,000 a coin under very particular conditions, which is no other competitors come into the market. And of course, the number of Bitcoins in the supply are constrained by the computer program. And if Bitcoin became stable enough to serve as a store of value, which it's far away from that. But if that happened, and you look at the value of all the gold in the world, and gold is considered a store of value, although it's also fairly volatile, then the number of Bitcoin, if Bitcoin as a class became as valuable as gold, it would suggest that Bitcoin should be about $100,000 a coin, or 120, whatever the number, whatever the arithmetic is. But there's a lot of conditions that have to fall into place for that to happen.
okay, and let me summarize sort of where I am in this time machine thing. I think of where we are as sort of a combination of the .com era with Bitcoin, with, let's say, this Terra and Luna, and I don't know that we want to go into that one, but if you look up Terra and Luna, that may have been the micro strategy of our time. That is the thing that kind of pops that bubble. And just, it seems like just a slight rise in interest rates is getting people to worry about whether valuations are going to keep going up. So a combination of the .com situation, which was, I mean, the NASDAQ, well, even specific, the subset of NASDAQ that was devoted to .coms collapsed way more than, let's say, the Dow in that period. And so we may be in a situation of a very uneven market where, where all of a sudden the companies that people didn't care what their earnings were, Tesla, we don't care, we just love Elon. that may come to a screeching halt the way it did for the dot-coms in 2000. And the other combination is this late 1960s to 1982 period where the economic situation was a challenge, and there was all this stagflation. And there it gets the question I think you raised, Matt, is sort of how far do interest rates have to go up to curb uh, to curb inflation? There are people who say that the Fed is going too slowly. On the other hand, what just by what little steps it's taken, it really has knocked trillions of dollars out of people's portfolios, and that could be enough to slow inflation. So I don't know. Let me throw it to Alan and let Matt think a little bit. Alan, do you have any sense? I know you, as a finance guy, you're not the guy to figure out where the equilibrium interest rate is, but you have any thoughts?
Um, well, first of all, it's always tricky when you say the Fed raised interest rates and we lost $1 trillion in wealth. I mean, it's never clear what the base year ought to be. So if you go back to March 2020, is the market any lower now than it was before before COVID started? We had the bust and then we had the boom. So you don't want to. I mean, it's always kind of overstating the case when you say we've lost X trillion dollars from the last peak, because the last peak, by definition, maximizes that number.
Yeah.
So I also, but when I think about what sort of makes sense as a equilibrium real interest rate, I don't think it should be negative, with where it's been for over a decade, about a decade. So I don't get the sense that the Fed is overshooting where it wants to end up. I mean, I don't know nearly enough to figure out if it's getting to where it wants to go too quickly. I just don't feel like I understand the macro scene that well.
Do you understand the bond market, which puts up with these negative real interest rates?
Well, not really. I mean, it's hard to come up with a rational investment story for why people are willing to do this. So I would not say that I understand it.
I think, well, in an inflationary environment, I guess everything's risky in some sense. I mean, there's no risk-free real asset out there, right?
Right. Although until this year, I mean, it's true that there's theoretically no real risk-free asset, unless maybe, you have exactly the right horizon for your tips or something. But until this year, if you had said to somebody, what is the standard deviation of your inflation forecast, it would have been so small that people would have, looked at these bonds and said, well, maybe I get that they're not theoretically risk-free after inflation, but they're pretty damn close. So I think that the fact that we now have this, unbelievable, 1 year pop in the inflation rate is just something that, I don't think it factored into anybody's investment decision, because I just think that they thought that this was, just totally out of the question.
Okay, yeah. So as of a year ago, nobody would have said, if somebody had said there's going to be 8% inflation, that if somebody had made that bet somehow, they would have made a lot of money because the market just didn't see
Yeah,
this.
exactly. Yeah, so it's like, the kind of, it's like one of these black swan things where this scenario was not in anybody's scenario analysis.
Okay. Matt, your sense of of interest rates, what the bond market thought, or any thoughts on those lines?
Yeah, I'm with Alan in that I can't explain why, and I have to admit, I have bonds in my portfolios too. But I've been conservative about that investment, or as we say, defensive in that piece of my investments. It's difficult to explain why bond investors had been, until the last, let's say, 6 to 7 months, been so enthusiastic about bonds. I mean, I think it would have been last calendar year was a great year for bonds, because interest rates, and certainly if you go from pre-COVID to the end of last year, it was a great 2-year period for bonds. Interest rates got incredibly low. So somebody, the Fed in part, was driving the bond market and happily investing in bonds. I said earlier that interest rates almost have to go up from where they are. Alan implicitly agreed. He said the equilibrium interest rate, whatever it is, and I don't know what it is, can't be negative. I would go a little further and say, in the long run, and the long run might be decades, but in the long run, it can't be much below the rate of economic growth, which, let's say for discussion's sake, is roughly 2.5%, maybe lower now, but let's say 2%. If the real interest rate is lower than the rate of economic growth, then investors can, and by investors, I don't mean stock market investors, I mean companies investing in projects. Investors can invest in projects, earn the economic growth rate of return on their investment, and borrow money to do it and make a profit. So and investors here includes the government, because the government can borrow presumably at whatever the bond rate is, invest in some project, a high-speed rail in California, or a bridge to nowhere, or military supplies, or whatever. And if they can make a return on that investment comparable to the rate of economic growth, and they can borrow at less than that percentage rate, then they can make a profit on it. So eventually, interest rates have to be comparable to the rate of economic growth, or else there are a lot of investors out there who will invest in losing projects. So where are interest rates now? Well, if you look at the TIPS curve, even the 30-year bond, which is the 30-year TIPS, which is the highest yielding of the lot, is only at about a 0.3% real yield. So, to use my analogy, the government can borrow at 0.3%, invest in some ridiculous project that makes only maybe 0.5%, and still come out ahead.
Yeah, I had a professor who used to say that the Army Corps of Engineers like to use a 1% discount rate because they could put a dam up on every river in the country, and have it pay off.
So I think, Arnold, you used the expression, which I can cite chapter and verse on, that something that can't continue forever will stop. And so interest rates can't be as low as they are now indefinitely, because they lead to investment in too many unprofitable
Okay, so
projects.
why aren't we all buying put options on treasuries?
Because it's risky. You don't know. I mean, 10 years ago, who would have said that interest rates would be essentially zero to negative for 10 years? Nobody would have forecast that.
So if
Um,
we would have, so 5 years ago, we would have said real interest rates look really low. Let's buy put options, and we would have lost our shirts.
you
So
would have through roughly November of last year. Yeah.
yeah. So you really have to time things right if you want to exploit, if that's an, even if it's an anomaly, if you want to exploit it, you've got to really get your timing down. Alan, do you have any thoughts on that one?
No, but it does remind me, Keynes is that famous joke that, the market can stay irrational a lot longer than you can stay solvent.
Yeah. Okay, let me open it up to the audience. Somebody, like, raise your hand or raise your icon, and all right, let me go with Mike here. Go ahead.
Unmuted. So just on that last topic, like, why aren't we buying puts? I did start buying puts as soon as the inflation prints came out and the bond yields were still that low. Like, I get it 5 years ago of, hey, inflation's at supposedly 1% or 2% and bonds are really low. But when inflation's at 8%, don't you think something's got to give? I mean, it's still a little speculative, and maybe there's a flight to safety in the US government bonds versus other government bonds. But it feels like that's a nice pressure point, having inflation come out at 8% and government bonds being at
So
1.5% for the 10-year.
so if you retired, I mean,
Not yet.
but that bet should have done pretty well.
Yeah, but yeah,
Yeah.
I didn't bet the house,
Yeah.
but I made a bet.
Yeah.
But I don't think that's a bad bet at all. I mean, the question is whether you believe the people who say that this inflation is just a supply chain blip and we're going to go back to the old regime. That sounded plausible 6 months ago. It sounds a lot less plausible now.
Well, if you're a pure monetarist in the Milton Friedman mode, you would believe inflation should be as high as it is and stay there for a while, because the monetary aggregates were growing so rapidly for so long that it's got to, in the monetarist view, it's got to filter through to prices eventually. And now it seems to have started. Now, on the other hand, the Fed, in one very particular sense, is a lot tighter than we might realize. That the monetary base, which is the very narrowest measure of monetary aggregates and the one the Fed controls most directly, actually has been shrinking in the last 6 months or so, although the broader aggregates have continued to grow very rapidly. So at least they're getting the direction right. I don't know, hard to know whether the speed or timing is right.
Yeah, I think it's pretty hard to follow any monetary aggregate and believe that you're following something that behaved the way it did even 20 years ago, because the financial innovation has just been so intense. I mean, just nothing like, certainly, when we were starting our careers, and there are so many things that exist now that did not exist then. You could not legally pay interest on a checking account when we were getting out of grad school. I mean, that's how different.
Buying gold was feasible, but very cumbersome.
Yeah.
Because you had to buy a brick or a coin. Now you can buy shares of ETFs.
Yeah. Yeah. There's a lot of changes in how, in the transmission mechanism from monetary policy to the economy, that I wouldn't even begin to be able to solidify. Any other comments, questions? Come on, you guys. I know you have some. All right, Lee, go ahead. Let me get you to.
So I would think about this in a few different ways. Number one is, though they are related, I would separate out the financial markets from the real economy. The financial markets will often reflect the real economy, usually in advance of what's happening, but they're distinct things. I I think at this point, as I've written in the past, I think there is a significant risk that we are in a recession already. In fact, I believe we are in a recession already. And that doesn't necessarily mean inflation is going to come down right away, but I worry more about the recession than I do about inflation. And when you think about the financial markets, I think a good way to think about when you've hit the bottom in the financial markets is to use a shorthand. In prior recessions, the right shorthand to use was 12 times PE on trough earnings for the S&P 500. So right now, we're far from the trough. Goldman Sachs thinks that the S&P 500 total EPS for all 500 companies in aggregate is going to be somewhere around $230 this year. So if you were to say, where's the market trading right now? 4,000 divided by 230 is, I don't know, somebody else can do the math. That's like 17 times or something like that. If you were to say, okay, well, what's the trough? It's not 230. It's far below 230, and the right multiple is not 17. It's probably 12. So is the trough going to be 150? I don't know. I mean, the trough in the last recession in 2009, the market bottomed at 666 in March of 2009, and that was also at a 12 times multiple on what was really trough earnings for the S&P. And it's, of course, it's frustrating when you say, well, shouldn't you have like a peak multiple on trough earnings? Shouldn't the multiple on trough earnings be higher? And the answer is yes, in theory, but in practice, fear rules the day, and people trade very differently. So a 12 times multiple on trough EPS would say the floor for the market is, I don't know, 2,000 for the S&P 500, maybe something in that ballpark. That I'm sort of, guesstimating there, but 12 times on say 150, 160 of earnings would get you there.
So are you saying we should buy puts on the S&P?
Yeah. I am, and I think that's the right strategy. Whether you think it's because the Fed has to keep raising, which they surely do have to keep raising rates, whether you think it's because the Chinese economy is a mess, there's a variety of reasons for it. Now, does that mean that every stock is going to go down? I'm sure there's going to be a couple of winners, right? One of the major themes of the past 15 years has been the outperformance of what are called growth stocks versus value stocks. And value stocks were the stuff where there's, supply and demand of a thing, steel companies and aluminum companies and chemicals and
utilities.
Right, utility companies that pay dividends. And people went, why are these things so cheap? And part of it was that when you have interest rates so low and you're looking at cash flows that are 5 or 10 years out for these internet companies, these growth companies, you would go, well, wow, those cash flows are worth just as much today as they are in 10 years. You don't have to discount them back at any sort of meaningful discount rate. And so you can say those cash flows are worth a ton. When those cash flows are 10 years out and interest rates are 5% or 6%, then suddenly that's a very different equation. And you're willing to pay a lot more for value that you're getting tomorrow, which you do from, a company that's actually generating profits.
All right. So you made the bold assertion that we're in a recession now. I'll say that, I've read the book Macroeconomic Patterns and Stories by Edward Leamer. And one of his most interesting findings is that that you don't see transitions from high rates of monthly job creation to low rates and vice versa, that there's a lot of momentum. So if you see, several months of 300,000 or more jobs being created, you're going to continue to see that for a while. So based on that, I would say if times are typical, we would not be in a recession yet, even though there are reasons to go into a recession. in terms of 1970s macro, I wrote today, all the curves are shifting to the left, right? The fiscal policy is becoming more conservative just by default. Like, you know, thanks to Joe Manchin, we're not throwing as much extra money at the public as we did. Monetary policy is by some measures contractionary, although maybe, if you look at the real interest rate, maybe not. Anyway, let's just say it is, assert that it is. And you have supply going back. So everything points to recession that way. But you'd have to, the growth in employment that we've seen would have to come to a screeching halt. Now, having said that, I've just, again, recent Wall Street Journal, is about all these tech companies saying, we got to conserve cash. And if other companies say we've got to conserve cash, maybe we do come to a screeching halt. But that certainly is, would be a risk for stock prices, that, a recession that some people are predicting, but that certainly isn't baked into earnings forecasts. I guess I'll put it that way.
If it's not baked into earnings forecasts, that of course means that, trough earnings are, again, they're not where we are now. It's not $230. It's there's a lookout below. Yeah.
You have any reaction to that, Matt? Are you being real conservative now because of that, or you don't think it's much of a risk?
I'm being a little bit conservative, just my investment style and a bit of the pressures of meeting clients where they are means I'll take some positions relative to whatever one might think of as a neutral position, but I don't go whole hog about it. But I don't disagree with Lee that the market has headwinds that it's facing. I said earlier, I think the market is a little bit overpriced, and if interest rates go up, it may be a lot more overpriced. Earnings, Lee makes a good point. Earnings could shrink from here. If you look, say, at aggregate statistics on earnings or corporate profits from the national income accounts, they're still well above the average of the last 70 years, going back to the origins of national income accounting after the war. Roughly, profits are about 10% of GDP, and on average, they're about somewhere around 6 to 8%. I forget the number. So, in principle, profits could shrink by 20% and still be fairly normal, no less the possibility that they could overshoot. So 20% below where we are at 230 is about 180. So give or take, I'm being very round. But 180 times 12, do the arithmetic. That wouldn't be surprising to see the S&P at that number rather than the 4,000 it is now.
Gosh, you really got me wanting to buy those puts on the S&P now.
So that's the bear case.
Now you're going to be a two-handed economist?
No, I'm not going to, because I already said I think the market's a little overpriced. I just don't have enough confidence in the data and the statistics because they're very noisy. There's a lot of variance in the data. So I just don't have a strong conviction about, oh my gosh, it's definitely going to be a bear market at 12 times 150 earnings. Right. I don't know.
Okay.
I make little small bets that the market's going down under current conditions. And next week, if the market goes down enough, I might change my mind.
Yeah. So, Alan, you have any words for us as we're nearing our hour?
So look, I always have trouble with these kind of questions because, you know, I was so inundated with efficient markets when I was in school, and it's really hard to break away from that. So the way I kind of try to square that is saying that, you know, I can't tell you whether the market is overestimating or underestimating next year's EPS. But what I do think is kind of something that you can look at is what's the aggregate risk aversion that you're seeing among stock market investors. And I think that is, in fact, sort of predictable. And like I say, I'm not sure if I'm getting into tautology land here, but I do think that you can say, look, I think people were systematically complacent and, you know, believing in ridiculous things like Greenspan puts and so forth in the last cycle. And, you know, they kind of begin to take for granted that the Fed is going to protect them. And then when that cycle breaks, all of a sudden you can see big changes in aggregate risk aversion. It's kind of like what we saw at the beginning of COVID, just sheer panic. So I think that the reasoning may differ. The conclusion, I think, is actually very consistent with what you guys are saying, which is that if you think that we've left, if we're leaving behind the last round of complacency, then that, you know, you can say, okay, risk aversion is going to go up, discount rates are going to go up, multiples are going to go down, and the market's going to get trashed. I think that it kind of takes you in the same direction.
All right, let me let Tom talk for, and then I'll try to sum up.
I was very interested in whether any of you would talk about alternative investments. You know, the people who own shares in Facebook or Tesla or whatever stock that is selling, they have money, and from my point of view, they don't have good investments. There was earlier talk about Bitcoin into IRAs or something, and that's because there's so much money looking for some kind of return. And so I think that talking about the valuations for the last 10 years, there's been essentially hyperinflation in stock market prices, which is why the PE has gone up. But and you say, well, it can't go up forever. And I say, well, why not? I mean, Japan for 3 decades has been at 200% of their GDP in national debt.
Well, so yeah, I think going back to Matt's point about when if real interest rates are low, there are an awful lot of good projects out there. And so the question is, who has the good projects? And, is it utility companies? Is it, as you start to go down the list, you probably see like political risk in a lot of the places that you think are good investments intrinsically. Like, who wouldn't want to have another oil well? Well, political risk. Who wouldn't want to own a utility? Well, political risk. So I guess what that suggests is a huge gap between the sort of the risky rates and the low and the risk-free rates. But that wouldn't explain why stock market multiples are high, because stock market multiples should be low if there's a lot of risk. Anyway, that's as I think about it, that raises a whole can of worms that I can't answer in a few minutes. So I think we did have an interesting discussion. We have 3 geezers who remember times when stock market multiples were lower. We remember times when there were recessions, and it's so. And I guess what I'd end on is that even though we remember these things, the economy is changing very, very rapidly. And that, I think that makes, so, a year from now, if I've kept this recording, we'll have said a bunch of stupid things probably, because there will be some events that have taken place that in hindsight look obvious, but right now don't. So when you're in the middle of a situation, which again, I think the amount of structural change in the economy that's taken place just in the last several years is so large that it's hard. If we're confident that I'd set the dial in the time machine properly to somewhere between the dot-com crash and the 1970s, then I think all of sort of our apparent consensus to buy puts all over the place would be a good one. But again, structural change can happen so quickly, and has happened so quickly that the other hand, I want to raise my other hand and be the two-handed economist and say that I'm not sure. Anyway, thanks Matt and Alan, and thanks everybody. And this will not be a Wall Street week, but if interesting things continue to happen, we may reassemble.
Great.
Thanks,
Well,
everyone.
thanks, Arnold, for having me. I really enjoyed the conversation. So
Yeah.
I'd come back to a reconvening anytime.
Okay. Well, maybe we will come back at some point when some of the uncertainty has been resolved, and we can say how stupid we were.
Yeah, then there'll be new uncertainties.
Yeah. Okay.
And we'll just remember that a lot of the Wall Street week forecasts didn't pan out either.
Yeah. No, but it was a fun show. I mean, he really had some great little puns, which I
Oh,
didn't.
he was a
So,
master at that.
yeah.
Yeah.
All right. Okay. Goodbye, everybody.
So long.
Bye.
Right.
Bye.